Welcome to this explainer. Today, we're diving into the earnings mosaic, consensus, whisper, and guidance. We are going to solve one of the absolute most frustrating, head-scratching mysteries in the entire stock market. Seriously, if you've ever watched a stock's price seemingly defy gravity, or even basic logic on earnings day, you are in the exact right place. We're going to break down exactly why that happens, and, more importantly, how you can actually see it coming.
Okay, so picture this. It's earnings day. A company you've been watching closely reports their quarterly earnings, and they officially beat Wall Street's estimate. It's a total champagne moment, right? A big green beat banner flashes across all the financial news networks. But then, you look at the stock chart and you are absolutely stunned. Because instead of climbing, the stock inexplicably crashes 15% by morning. You're just left scratching your head wondering what on earth went wrong here.
So really, how does a company beat the estimate, yet the stock crashes 15%? Well, investors aren't confused here. They're actually disappointed. Why? Because that headline number that was just broadcast to the entire world, the official one, isn't the number that actually mattered. The number the market is truly reacting to is one that literally nobody officially publishes.
Section 1. Unpacking the earnings mosaic.
To make sense of this, we have to start with the absolute golden rule of stock pricing. And that is, stock prices equal the present value of future expectations. Let me actually repeat that, because it is the foundation of literally everything we do. Stock prices reflect what is coming next, not last quarter's results. The past, it's already priced in. The market is just a giant, forward-looking discounting machine. Because price is built on future expectations, the single number you see in a news headline on earnings day is kind of just an illusion. It's actually a mosaic made up of 3 distinct layered numbers. Layer 1 is the consensus estimate. Layer 2 is the whisper number, and Layer 3 is guidance. As an active investor, your job, before you even think about trading near an earnings date, is knowing exactly how these 3 layers interact and which one is really driving the bus.
Let's see how this builds by comparing those first 2 layers. The consensus estimate is basically the average forecast from Wall Street analysts compiled by services like First Call. But here is the secret mechanism that goes on behind closed doors. Companies routinely and very quietly manage this number down ahead of time. They give soft signals to analysts to lower the bar. Why? Specifically so they can jump right over it, declare a beat, and generate a great headline. But on the other hand, we have the whisper number. This is the unofficial, real expectation circulating among active traders and institutions. And guess what? It is almost always higher than that manufactured consensus.
And this right here brilliantly illustrates why so many everyday investors get trapped. The beat is often manufactured, not organic. The whisper number acts as the market's true lie detector. If a company beats the official consensus but fails to meet that higher unspoken whisper number, the market is disappointed. And that is exactly what causes a stock to plunge, despite a public headline screaming, "Earnings beat."
But there is a third layer to this mosaic, and honestly, it is the ultimate driver: guidance. Think of guidance as this giant forward-looking telescope. This is the company's own forecast for future quarters. Because of our golden rule, you remember that stock prices are built entirely on future expectations. Guidance is the heaviest weight on the scale. So here is your executable rule. Raised guidance is frequently much more bullish for a stock than an incredible beat on the current quarter.
All right, Section 2, the earnings day quiz. Let's see how well we've absorbed this. I'm going to give you a rapid-fire knowledge check so we can actively apply the framework we just covered. Here is the scenario. A company reports their earnings. They beat the consensus estimate by a really solid 5%. However, during the report, they issue weak guidance for the next quarter, citing, some supply chain headwinds. Take a second. Which way do you predict the stock will move?
Well, if you said it drops, you absolutely nailed it. It goes down in most cases. The crucial takeaway here is that future expectations will always outweigh backward-looking beats. That weak guidance acts like a dark cloud over the present value of the stock, entirely overriding that manufactured backward-looking beat. This is exactly the mechanism from the mystery we set up right at the beginning of this explainer, and now you know how to see it coming instead of being totally blindsided by it. Section 3. Finding the real signal.
Understanding the theory is great, but now let's talk about practically applying this before your next trade. We've got to filter out the noise. And this really comes down to avoiding the amateur mistake and adopting the professional approach. See, the amateur sees a beat or miss headline on some free news app and immediately hits the buy or sell button. That is just trading on headline noise. The professional, though, They look at the real signal. They analyze the full mosaic. They're asking, hey, did we beat the whisper number? And what did management actually say about the next 6 months?
So here is your action plan. The core takeaways you need to apply from here on out. First, question every single beat headline you see. Just assume the bar was lowered intentionally. Second, before earnings day, hunt down the whisper number. There are plenty of financial sites out there entirely dedicated to tracking these real expectations. And third, heavily weight the forward guidance above everything else. Doing this empowers you to identify which layer of the mosaic is actually driving the price action right there on your screen.
You now have the tools to read the true earnings signal. But even if you read this mosaic perfectly, there is still one devastating trap that catches traders who get their timing wrong. In the next part of this explainer, we are going to dive into the announcement trap, otherwise known as buy on the rumor, sell on the news. Are you ready to learn the exact protocol to avoid getting crushed by sudden gaps in price? And the mental model you need to turn sudden market shocks into a calculable edge? Join me in part 2 to find out.